digital asset treasury companies based on Ethereum and Solana. Why? Because they're de facto being deemed commodities by the current administration. So they have de facto commodity status.
Point is, of course, peer-to-peer electronic cash. And so like I could peer-to-peer electronic cash with any of you here, and that's great, but if you're Walmart with 10,000 stores globally doing $680 billion, peer-to-peer electronic cash isn't really working. So you're still gonna need payment providers, you're still gonna need to pay hundreds of thousands of employees, you need payroll companies, so a lot of financial institutions in that space. And then ultimately, the last category, I still see, I think, a lot of improvement, I think where these treasury companies move into this financial future is security.
Bitcoin Treasury companies, what we're seeing is a merging of both of those things together. We're getting exposure to own the protocol layer with the bridge that is the Treasury company itself. And I think that's a phenomenally interesting idea for where the future is going to go for these financial institutions.
Taking Saylor's thesis a step further, Mark Moss paints a picture of a financial system in transition. He starts with a staggering number, $700 trillion sitting in the financial system, generating meager returns of 0 to 8%. This vast pool of capital is ripe for a new, more efficient paradigm. Moss argues that the digitization of capital, the ability to slice it up and issue new instruments against it, will transform what survives and what collapses. While traditional functions like saving, credit, and payments will always be needed, the institutions providing them will change. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
The Treasury Company. Well, a Treasury Company is a corporation that's capitalized on digital capital that issues securities against the underlying digital capital. Why is it it is a new class of finance company, a new type of company. There's insurance companies, there's banks, there are fund companies, there's finance companies, there are REIT, real estate development companies. There's plenty of types of companies and there's operating companies. Why is a Treasury company new and different? It's because the Investment Company Act of 1940 prohibited publicly traded companies from capitalizing or leveraging on securities portfolios. That's why there's never been a Mag 7 Treasury company, there's never been an S&P Treasury company. You can leverage and you can 100%, this is why Warren Buffett has to sell Apple stock. This is why the Berkshire Hathaway portfolio of securities stays below 40% of its liquid assets. That's why he has so much Treasury bills. The Investment Company Act created a carve-out for sovereign debt of the United States government. And so even though those are technically securities, they're deemed to be not securities or commodities for the purposes of the SEC 40 Act. That being the case, for any of these strategies to work, you have to go to 100% or more leverage. If you're only holding 10% of something, it's not enough exposure to make it a type of company. So the Treasury Company was born with the arrival of digital commodities, and specifically Bitcoin, the digital scarcity. You could lever a public company on gold, but gold is not exciting enough. 99% of investors don't think gold is a good long-term asset. It kind of tries to keep up with the S&P, but as a practical matter, to break through a new thing, it needs to be an order of magnitude better. And so because Bitcoin has been able to outperform the S&P by 3 or 4x, it's enough better that you could justify taking the risk on a brand new revolutionary thing. So what you see is now the rise of 180 public companies capitalized on Bitcoin. You also see an explosion of digital asset treasury companies based on Ethereum and Solana. Why? Because they're de facto being deemed commodities by the current administration. So they have de facto commodity status. If any other token were deemed a security, you couldn't pursue this strategy. That means all told, you got about 250 companies that are digital asset treasuries. And and you would say, well, can I do it with gold? Not really. Gold's too slow, too boring. Real estate, you've got REITs, but real estate underperforms the S&P. Soybeans, oil, people tried all sorts of things, but at the end of the day, if you've got a digital commodity which outperforms the S&P, you have enough performance to create a treasury company. Now the issue is, how will the industry develop? And we're in year one of this thing being birthed. And of course, 90% of the investors don't even believe it's a category. They don't even recognize it. 1% are enthusiastic about it. 2 or 3% are stumbling around. And with that as a preamble, I guess, Mark.
Bitcoin, however, is a different story. Its ability to outperform the S&P by 3 or 4 times provides the necessary catalyst. This superior performance justifies the risk and the pioneering effort of building a brand new model. The result is the emergence of over 180 public companies now capitalized on Bitcoin, with hundreds more using Ethereum and Solana, which are currently being treated as commodities by the current administration. This de facto commodity status is critical, as any asset deemed a security would make this strategy untenable. The rise of the digital asset Treasury Company is a direct response to this new economic reality.
We have a new asset like Bitcoin that's the digitization of capital, and it moves at the speed of capital. We have a new set of building blocks to build new things. And so we can kind of think about the financial system as we have today and then how this transforms it. And so we can kind of think about maybe what doesn't survive in the financial system and maybe what moves forward in the financial system. And so if you think about the $700 trillion sitting in the financial system that's earning somewhere between 0 to 8% right now today. But we can take this digitization of capital and then we can slice it up, as Saylor showed us, with different types of preferreds and different types of instruments that can provide something. As he said, typically treasuries have sat in that spot. We have 250 million people in the developed world right now, retirees, depending on some source of income. Again, $700 trillion of capital sitting on that income. And it needs better income, better yield, something safer than bonds. And so this new asset, this new digital asset that moves faster, that gives us this better CAGR, that gives us that room to then leverage into the S&P 500 and leverage into the debt and credit markets, it allows us to do these things. So I think some of the types of new financial institutions that we see kind of getting built on top of this are sort of interesting. Like, obviously, we're still going to have creators creating more than they consume, and there's going to need to be savings. So there's going to be financial institutions that will handle security, that will handle custody and things like that. I think we'll always have a need for credit. So we'll have financial institutions that are still providing credit. People are still going to need to buy houses. They're still going to buy cars. We're still have entrepreneurs that need capital for businesses as well as scaling businesses. It'll be, as Mises would call it, commodity credit versus circulating credit. We'll be issuing credit off of savings. It's not just conjuring out of thin air. I think insurance is going to be a very interesting financial model in the future, specifically with Bitcoin. Warren Buffett showed us the power of having a float with insurance companies. So imagine if you're good at adjusting risk. If you're good at writing risk, you get the power of the float, put that into a Bitcoin standard. I think that's pretty powerful. I think, obviously, I think about liquidity. Bitcoin is, of course, peer-to-peer electronic cash. And so, like, I could peer-to-peer electronic cash with any of you here, and that's great. But if you're Walmart with 10,000 stores globally doing $680 billion, peer-to-peer electronic cash isn't really working. So you're still going to need payment providers. You're still going to need to pay hundreds of thousands of employees. You need payroll companies. So a lot of financial solutions in that space. And then ultimately, the last category, I still see, I think, a lot of improvement. I think where these treasury companies move into this financial future is securities. So we're still going to need, companies will still need to raise money, we'll still need to bundle the money, we'll still need price discovery in the markets and things like that. But the difference is that we've had, this equity security market for 430 years built on fiat. And I think it all just transitions over to Bitcoin, moves faster, it's stronger, more transparent. And so really what happens is the Wall Street, the financial institutions are still there, but the Wall Street scaffolding that we have today is mostly collapsed. Things move faster, more transparent, and on a Bitcoin standard.
Brian, what do you think?
Yeah, from my perspective, one of the things I find very interesting is 13 years ago when I got involved in Bitcoin, there was a concept that I discovered that really inverted my thinking around the opportunity for investing and changed my mind around it. Historically, you have the protocol layer and the application layer. And the protocol layer would be things like IP, Internet Protocol, or HTTP, or SMT for Simple Mail Transfer Protocol. And you could never buy a chunk of that to monetize off its growth and adoption and value over time. You had to invest at the application layer, which was businesses like AOL and Yahoo and Google that had these different providers, and you monetized off that. So all the value accretion occurred at the application layer because we didn't have the chance to buy in at the protocol layer. Then, when blockchain and Bitcoin was developed, that investing scheme got inverted, right? We can now buy a chunk of that protocol and we can own it and hold it. And if you look at the return profile over time versus owning the protocol layer compared to owning the applications built on top, the protocol layer has significantly outperformed the applications. Now with Bitcoin Treasury companies, what we're seeing is a merging of both of those things together. We're getting exposure to own the protocol layer with the bridge that is the Treasury Company itself. And I think that's a phenomenally interesting idea for where the future is going to go for these financial institutions. And the outperformance opportunities with that, I don't think we've even seen the beginning of where that can go. And if we think about it from a systems perspective, when you have an old failing system, i.e. our traditional fiat banking system that exists today, these systems are not going to just naturally adopt Bitcoin because it's going to disrupt their own business models. So what happens? You have to build the brand new system on your own so it disrupts those models, and then they are forced to adopt it over time. And that's what we're seeing with Bitcoin Treasury companies. And I think as we think from a future-facing perspective, and I agree with everything that you noted about the different types of products that can come into it, but what about the markets that don't even exist yet and how Bitcoin Treasury companies can engage with them? So let's walk through an example. Think of artificial intelligence virtual agents, right? Every time we question Grok or Perplexity or ChatGPT, there is an electricity and computational expense that's required to query that for it to process the data and information that comes back to us, right? Eventually, we will have a virtual economy of trillions and trillions of artificial intelligent bots doing things that we aren't even aware that they're doing, right? And there's going to be a computational and electricity expense with those bots doing that labor. Well, they can't set up a Bank of America account. What can they accept? They can accept something like Bitcoin. So what if maybe the future of Bitcoin Treasury companies, one of the products and services they provide is to serve the ever-growing adoption of the artificial intelligence market by providing financial services and products in an internet-native way. So I think that's an interesting thing to think about in future of the years to come.
The conversation between Michael Saylor, Mark Moss, and Brian Dixon reveals a powerful, coherent vision. They argue that we are not just witnessing the rise of a new asset, but the birth of a new financial system. The old rules are breaking, and the builders of the new financial world are laying the foundations for a future where capital is digital, transparent, and built on a foundation of absolute scarcity.